What's going on YouTube? It's your boy Chris, aka The Capital Connect, and in today's video, I'm going to be going over what I believe to be one of the easiest scalping strategies you can use to trade futures. Now, I've been back testing and tweaking this for months, and I finally feel like I got it down to where I can now give it to you guys. So stay plugged in, man. This is going to be a good one. So the model we're going to be going over today, guys, is going to be known as the unicorn model. Now, what is the unicorn model? Essentially, you need three things, guys. You need a sweep of liquidity, right? If you don't understand liquidity, go watch my video on my channel. I made a whole video about it, going in detail and how I like to use liquidity. So you need a sweep of liquidity. You need a breaker block. What is a breaker block? A breaker block is just a failed order block. That's all it is. And then number three, and final, you need a fair value gap. Okay, so sweep of liquidity, breaker block, fair value gap. That's all you need, right? And the fair value gap needs to be overlapping the breaker. Okay, that's literally all you need. Now, these are just some basic drawings I have of the model, and then of course we're going to jump into some real examples on the chart. But as you can see here, we have a bearish model, a bearish unicorn model. So we have a sweep of liquidity in the form of this high, right? We, break structure down, making this order block fail, turning it into a breaker block. And then we have a fair value gap overlapping that breaker block. So we would enter on the fair value gap. And then for the bullish example, we have a sweep of this low, right? We, break higher, breaking this order block here, turning it into a breaker block. And we have a fair value gap overlapping the breaker as well. So sweep of liquidity, breaker block, fair value gap, very simple. Now let's go ahead and jump onto the charts and see a real example. So for our first example, guys, we are on NQ's 5-minute chart. Now, what is the first thing I said we need? We need a sweep of liquidity. So as we can see here, we took out London's low right here. We have swept London's low. Now, when it comes to liquidity, guys, I understand that it can be very confusing and overwhelming simply because liquidity is honestly all over the place. So in order to keep yourself sane from, just constantly looking for a liquidity sweep, let's focus on what I like to call high probability liquidity areas. Now, I haven't heard anyone else use that. I'm not going to sit here and say I am the first person to use that, but if I am the first person to use that, y'all remember that, and y'all remember this video, bro, because I'm gonna claim it. So I like to focus on what I call high probability liquidity areas. What are those areas? It is session highs, session lows, daily highs, daily lows, and obvious liquidity like, double tops, double bottoms, and obvious ranges. So I call those high probability liquidity areas because I have noticed in my experience and in my back testing that when we get a sweep of any of those areas, price typically likes to react in an aggressive manner, going the opposite direction, which would be good for this strategy that I'm teaching you guys. So like I said, for this first example, we get a sweep of London's low. That's check mark number one, right? That's the first box check. Now, what is the next thing we need? We need a failed order block. Now, if you've been on my channel for a while, you know that I have multiple videos going over order blocks because I used to trade them almost exclusively. So for this particular strategy, guys, it doesn't matter if it's a high probability order block or a low probability order block. It just needs to be an order block. It just needs to be a failed order block. So we can see that we have a failed order block here. This is the last bullish candle that caused the displacement down that took out this low. So this is an order block. So we have a sweep of liquidity. That's, box check number one. Box number two is checked by having a failed order block. So now all we need is a fair value gap. Let's see if we get it. So we see that we do get a fair value gap that is overlapping our breaker block. And matter of fact, let me change this so it can be distinctive. So we have a fair value gap that is inside of our breaker block, right? We now have all the boxes checked. Now, what do? You enter at the opening of the fair value gap. Right now, where does your stop loss go? Your stop loss can go one of three places. It can go below the fair value gap candle itself, it can go below the breaker block, or it can go below the 3 candle sequence. Now, in this particular example, it doesn't really make a difference if we choose between the fair value gap candle or the breaker block candle. But in this particular example, let's just go ahead and put it underneath the 3 candle sequence just to give ourselves a little bit more room. In most cases, guys, if I can, I will put my stop loss below the 3 candle sequence just to give myself as much room as possible. So we got our stop loss below the 3 candle sequence. Now, where would my first TP go? My first TP is always going to be the recent high or the recent low, or it's going to be the closest high and the closest low. So in this particular example, we can see that the closest high that makes sense is going to be, you know, what just so happens to be London's high. So at this point, when price gets to here, this is where I will officially move my stop loss to break even. Okay, my stop loss is going to break even, and I may or may not take a partial once we get up here, right? It all just really depends on what I'm looking for the day. So my first TP is going to be the closest high or the closest low. Okay, now once we go break even, where's my second target? Well, it's just going to be opposing liquidity, guys. When it comes to this strategy, okay, you have to understand this. Once we take out liquidity going in one direction, what we should be targeting next is liquidity going the opposite direction. Okay, so we took out a low, so now we should be looking to take out highs, right? So my next TP after taking out London's high could be, okay, let's take out Asia's session high. So let's go ahead and play this out, and you know, I'll kind of just do it, you know, play by play. So let's watch the next candle and see what happens. So we get tagged in right there. We are now entered on this trade. Let's see what happens. Boom. All right, we just took out London's high and we just hit my break even point. At this point in time, guys, my stop loss is going to break even. I am now in a risk-free trade. Now let's go ahead and continue to play it out and see if we can get to my final TP. And as you guys can see, we smashed through the final TP. At this point, I will be fully out. And bro, yeah, we'll just let that go. It'll be on to the next trade. Now let's go ahead and play this out to see how much further it went. And as you guys can see, man, this thing just cooked up for the rest of this AM session. You could have got well over, you know, 140 points on this particular trade. And that's just if you held it all the way through. But let's go ahead and go to another example. So for our next example, guys, we are still on NQ on the 5-minute chart. Now, what are we looking for? We are looking for a sweep of liquidity. Where is our sweep of liquidity? We can see that we took out a high probability liquidity area in London's low. So now the next thing we need to be looking for is a failed order block. What do we have right here? We have a failed order block. Now, this is what I was talking about earlier when I said, you know, don't worry about if the order block is high probability or not. There just needs to be an order block. So this is the order block right here, this bullish candle right here. This is the order block that caused the breaker structure / sweep of liquidity. Okay, so we got a sweep of liquidity, we got a failed order block, being because this bullish candle right here closed above this order block. So now all we need is a fair value gap. Let me delete this because I'm kind of already showing you guys the result, but let's go ahead and play it out a little bit. We see that we do get a fair value gap. So now we are setting our limit order right here at the opening of the fair value gap, and our stop loss would go below, in this case, you know, the fair value gap candle. So in my back testing, guys, it really does make sense that if you want to have the highest chance of winning and not getting stopped out and then the trade going in your favor, you're gonna want to have your stop loss below the fair value gap candle and or below the 3 candle sequence. And in this particular example, we have both. So stop loss below the fair value gap candle. Now, where are my TPs at? Let me play it out a little bit more just to see. Okay, so we get tagged in right here. In this particular example, I will be going break even once we take out this recent high. Okay, so this will be my break even point / TP1. Now that is a little under a 1-to-1 right there, so that's a little bit unfortunate, but you know what I'm saying, that is where I would be going break even. My next target would be to take out London's high, right? And then my last and final target would be, you know, taking out Asia high, because what did I tell you guys before? When we are taking these setups, we want to take opposing liquidity going in the opposite direction. So all of these are old highs. So these are going to be the areas we are looking to take out. So let's go ahead and play this out a little bit and see what happens. All right, so we get tagged in, we get a great reaction coming out of our zone. All right, we are now break even at this point because we just took out this high, and that is our break even point. So at this point we are break even. Now let's go ahead and keep it playing. You get a little nervous if you didn't close anything right there, but as you can see, we end up hitting TP2. Right, you can take another contract off right there if you're trading with multiple contracts. And then playing this out even more, we can see that we eventually hit TP3 and beyond. So let's go ahead and get into a bearish example now that I've shown you guys two bullish examples. All right, so for our final example, guys, we're going to be going over a bearish setup. So what is the first thing we're looking for? As always, we are looking for a liquidity sweep. We can see that we get a liquidity sweep right here. Right, we sweep London's high. Now, this is kind of tricky because this bearish candle right here, this was a news candle, right? So we wouldn't be confident in taking any setups off of this fair value gap just because, like, it's a news candle, and we know when it comes to news, like, news does whatever it wants. So we don't want to really be taking any setups, you know, directly off of news, and especially off of news setups. So we're just going to be patient, and we're going to wait, and we're going to see what happens. So as we can see, after we're patient, we end up respecting this bearish order block. Right, price taps into it and it immediately rejects, right, causing a unicorn setup. Where right here, guys, we have an order block right here, a bullish order block that fails. It gets disrespected. So this now becomes our breaker block. Why is it disrespected? Because we have a candle closed beneath it. Now all we need, guys, is a fair value gap that is overlapping that breaker block. If we get a fair value gap overlapping that breaker block, we are good to go. So let's go ahead and play it out. We see that we do indeed have a fair value gap overlapping this breaker block. Now, this is obviously a huge gap and a huge zone, so your stop loss would be huge. How can we minimize our risk and possibly get a better entry? We can use consequent encroachment of this fair value gap, right? So we can enter at the 50% mark. By the way, if you don't know how to get that on your rectangle, you just use your rectangle tool, right? Double click on it and turn on the middle line, right? That's how you get the 50% point, the 50% mark of your rectangle, which is known as consequent encroachment. So we can enter at consequent encroachment of this bearish fair value gap. And in this particular example, since our stop loss would be huge if we put it above the fair value gap candle itself, we can just put it above the breaker block and live with the results if price decides to, you know, breach that breaker block, right? So target would be the recent low. So let's see what happens. We're waiting, still being patient. Boom, we get tagged in right there and get a beautiful reaction. Let me move this over a little bit. We get tagged in right there, beautiful reaction. Honestly, bro, since this TP is so far away, that wouldn't even be my break-even point. That would literally be my final TP. You know, if I'm not cool with 88 points on NQ, something is wrong with me. So this would be probably TP1 and my only TP, because I mean 89 points, bro, please, come on. Like, that's all we need. If I can get that every single day, I'll be a millionaire. Now, we can see this, play this out, and we can see plays out beautifully, man. So that is the unicorn model, guys. I hope that this video helps you guys out. Now let's just do a quick little recap, okay? We need a sweep of liquidity. We need a breaker block, which is just a failed order block. And then we need a fair value gap overlapping our breaker block, right? It doesn't have to fully overlap it, but it has to, like, part of the breaker block has to be overlapping the fair value gap. So this strategy, in my opinion, is one of the easiest. I've been back testing it for months and I've been loving the results. And I've been tweaking it for months as well. So these are all my rules. Like I said, when it comes to my TPs, I am putting it at the recent high or the recent low as far as my break-even point / TP1. Then when it comes to the final TPs, it's just going to be targeting opposing liquidity. So if it's a bullish setup, I'm looking to take out highs. And if it's a bearish setup, I'm looking to take out lows. Very simple. And then as far as stop loss placement goes, guys, you can put it one of three places. You can put it you know, above and or below the fair value gap candle itself, above and or below the 3 candle sequence, and above and or below the breaker block itself. So like I said, I hope this video helps you guys out, man. Let me know if you guys decide to use this, and let me know the results you guys get. As always, if you guys have any questions, definitely drop them in the comments and I will answer any questions that you guys have. But that's all I got for this video. I'm gonna catch you guys in the next one. I'm gone.